Executive English, explain rates volume, right pointing arrow equity volume in 2 to 3 lines. Welcome! In this quick session, you'll learn to speak like an equity strategist without drowning in jargon. By the end, you'll be able to explain macro drivers in 2 to 3 sentences. Clear, punchy, and credible. We'll focus on connecting rates volatility to equity volatility, so you can say not just what happened, but why it matters for prices and multiples. Think of this as a toolkit for daily market notes, morning meetings, or client updates. Short, sharp, and useful for high-stakes conversations. Start with a shared vocabulary. Rates volume means how unstable bond yields are. When yields swing, uncertainty about the future path of policy and growth is high. Equity volume is how jumpy stock prices are. More jumps mean wider day-to-day moves and bigger gaps on news. Risk premium is the extra return investors demand to hold risky assets instead of safe ones. It rises when uncertainty rises. A transmission channel is the pathway one market uses to affect another, like yields changing the discount rate used to value stocks. Here's the engine. When rates volume rises, the discount rate used in equity valuation becomes less predictable, so investors pay lower multiples, and equity volume climbs. When yields are stable, valuation math is steadier, equity volume compresses, and multiples can expand. The mix of growth versus inflation matters. Growth uncertainty usually hits cyclicals and small caps. Inflation uncertainty boosts the term premium, pressuring long-duration assets like tech. Always tie the macro mix to who feels it most. Use tight lines with clear causality. Rates volume sets the risk-free anchor. Equities price the noise. When yield uncertainty rises, multiples derate, especially for long-duration names. Softening rates volume supports a relief bid in cyclicals as discount rate pressure eases. Sticky inflation keeps the term premium and equity volume elevated, capping multiple expansion. These phrases are crisp, directional, and signal the channel driving price action. Lead with the driver, then the equity effect. Example: move in rates volume lifts equity volume, tech underperforms. Name the channel. Is it the discount rate, earnings outlook, or positioning/liquidity? Add a time frame so your view is tradable. Today, this week, or next quarter. This structure turns scattered observations into a clean, decision-ready narrative that portfolio managers can act on quickly. Steal these formats. Bearish. Spike in rates volume lifts equity volume, compresses long-duration tech. Neutral. Cooling rates volume stabilizes multiples. Earnings now drive dispersion, so stock selection beats beta. Bullish. Declining term premium eases equity volume, supports quality re-rating. Favoring cash-generative leaders. Each line names the driver, states the channel, and lands on who benefits. Fast and investable. Anchor your view to one clean metric at a time. For rates, cite MOVE to gauge rates volume. For equities, cite VIX. Add one macro lever: term premium, break-evens, or real yields. Not all three at once. Example: move down 10 points. VIX softer, lower term premium easing equity volume. One metric per sentence keeps the message clear and avoids jargon soup. Before you hit send, run this quick audit. 1. Name the macro driver first. Rates volume, term premium, break-evens, real yields. 2. State the linkage to equity volume or multiples via the discount rate or earnings channel. 3. Give a concise, time-bound view. today/this week/next quarter. 4. Close with who benefits or hurts. Call out sectors or styles like tech, cyclicals, small caps, or quality. Clear, causal, and actionable. That's strategist level communication.